Hello everyone, I want to share something very personal today, my journey through the treacherous world of investing. It is a story filled with mistakes, regrets, and ultimately invaluable lessons that I believe can help many of you. When I was younger, I had a burning desire to achieve financial independence quickly. This desire, while common, led me down a path of poor decisions and significant financial losses. I grew up in a very ordinary household, and financial literacy was not something that was taught or discussed openly. So, when I first started earning money, I felt a strong urge to make it grow, and to grow it fast. I was easily swayed by the allure of high returns and rapid wealth accumulation. My initial approach to investing was driven by emotion and a severe lack of knowledge. I would hear about certain stocks or assets that were performing exceptionally well, and without proper research or understanding, I would jump in, hoping to catch the tail end of a rally. This often resulted in buying at the peak and selling at a loss, a classic rookie mistake. One vivid memory involves a particularly speculative stock that was constantly in the news. Everyone seemed to be talking about how it was going to revolutionize an industry, and its price was climbing day after day. I felt an intense fear of missing out, or FOMO, and decided to invest a substantial portion of my savings into it. I did not understand the company's financials, its competitive landscape, or even its long-term prospects. I was just riding the wave of popular sentiment. For a short while, my investment did go up, feeding into my illusion that I was a genius investor. I imagined all the things I would do with my newfound wealth. Then, as quickly as it rose, the stock plummeted. There was no specific bad news, just a general market correction. But because the stock was so overvalued, it fell harder and faster than others. I held on for a bit, hoping for a recovery, but my losses kept mounting. Eventually, I capitulated and sold. Realizing a significant portion of my capital was gone, the feeling of loss was crushing, and the realization that I had let hype, rather than logic, guide my decisions was a bitter pill to swallow. This was not an isolated incident. I repeated this pattern with other hot stocks, always chasing the next big thing, always ending up with less money than I started. My portfolio became a graveyard of speculative bets and emotional trades. Another major pitfall for me was falling victim to various investment scams. These were often promoted through social media or online forums, promising astronomical returns with minimal effort. One particular scheme involved a high-yield investment program, HIP, that claimed to trade in foreign exchange markets. They had a professional-looking website, convincing testimonials, and a referral system that seemed to pay out consistently, at least in the beginning. I started with a small investment, and true to their word, I saw daily returns credited to my account. This built a false sense of security and trust. I started telling friends about it, and some of them even joined. As my confidence grew, I invested more and more, even taking money out of safer investments to put into this high-yielding program. Then, one day, the website was gone, the support channels disappeared, and all communications ceased. My money and the money of my friends whom I had influenced vanished into thin air. It was a devastating blow, not just financially, but emotionally. The guilt of having led others into the same trap was immense. This experience taught me a profound lesson about due diligence, skepticism, and the critical importance of understanding where your money is actually going. If an investment promises returns that are significantly higher than the market average, it is almost certainly a scam. My biggest mistake, perhaps, was my complete disregard for risk management and diversification. I often put all my eggs in one basket, believing that a single successful investment would catapult me to financial freedom. This was particularly evident in my early ventures into cryptocurrency. During a crypto bull run, I saw friends and acquaintances making huge sums of money. I felt like I was being left behind. Instead of learning about the underlying technology or the long-term potential of various projects, I simply bought the coins that were gaining the most traction, believing they would continue their upward trajectory indefinitely. I invested a disproportionate amount of my savings into a handful of these volatile assets. I did not understand the concept of market cycles, the inherent risks of such a new and unregulated market, or the importance of not overextending myself. When the inevitable crypto winter came, many of these coins plummeted by 80%, 90%, or even more. My portfolio was decimated. I was left with a fraction of my initial investment and a deep sense of despair. This experience hammered home the importance of diversification, not just across different asset classes, but even within them. It taught me that putting too much capital into any single, highly volatile asset is a recipe for disaster, regardless of how promising it might seem at the time. Beyond the specific investments, my emotional state was a constant impediment to rational decision-making. I was driven by fear and greed, two of the most dangerous emotions in investing. When prices were rising, I would become overly optimistic, sometimes even euphoric, believing that the good times would never end. This led me to take on more risk than I should have. and to ignore warning signs when prices were falling. I would panic, selling out of positions at the worst possible time, locking in losses that could have been avoided with patience. I would constantly check my portfolio, experiencing a roller coaster of emotions with every market fluctuation. This emotional trading was exhausting and ultimately unprofitable. I realized that to be a successful investor, I needed to detach my emotions from my financial decisions and adopt a more disciplined, systematic approach. The turning point came after a series of particularly bad losses. I was financially bruised and mentally exhausted. I looked at my bank account, then at my investment statements, and finally understood that my current path was unsustainable. I was not building wealth, I was consistently destroying it. It was a painful moment of self-reflection, but it was also incredibly liberating. I decided then and there that I needed a complete overhaul of my financial mindset and strategies. I stopped listening to the noise, the endless tips, and the get-rich-quick schemes. Instead, I started investing in myself through education. I devoured books on personal finance, investment strategies, and economic principles. I sought out reputable financial advisors and educators who emphasized long-term thinking, risk management, and diversification. I learned about the power of compound interest when applied over decades, the importance of consistent savings, and the value of investing in broad market index funds. I began to understand that true wealth is not built through speculative bets, but through patient, disciplined, and consistent effort. My approach completely transformed. I started building a diversified portfolio primarily consisting of low-cost index funds that track the broader market. I automated my investment, so a fixed amount would be invested regularly, regardless of market conditions. This removed the emotional component from my decision-making. I focused on saving more, spending less, and living within my means. I learned to embrace market downturns as opportunities to buy more assets at lower prices, rather than panicking and selling. I am not a financial guru, and I do not claim to have all the answers, but I have been through the fire and I have emerged with a much clearer understanding of what works and what does not work. In investing, I want to share these hard-won lessons with you, especially if you are just starting your financial journey. Do not make the same mistakes I did. First and foremost, prioritize financial education. Before you invest a single dollar, invest time in learning the fundamentals. Understand concepts like inflation, diversification, asset allocation, and risk tolerance. There are many free resources available online, in libraries, and through financial literacy programs. Knowledge is your best defense against bad decisions and predatory schemes. Second, develop a clear financial plan and stick to it. Define your financial goals, whether it is buying a house, retiring early, or funding your children's education. Create a budget and track your expenses. This plan will serve as your roadmap, guiding your decisions and helping you stay disciplined even when markets are volatile. Third, always diversify your investments. Never put all your capital into one stock, one sector, or one asset class. Spread your investments across a variety of assets to minimize risk. For most young investors, low-cost, diversified index funds or exchange-traded funds, ETFs, are an excellent starting point. They offer broad market exposure and reduce the risk associated with individual stock picking. Fourth, be extremely skeptical of anything that promises abnormally high returns with little to no risk. These are almost always scams. If an investment seems too good to be true, it almost certainly is. Conduct thorough due diligence. Verify the legitimacy of the company or platform, and never invest money you cannot afford to lose in speculative ventures. Fifth, learn to manage your emotions. Fear and greed are powerful forces that can derail even the best investment strategies. Avoid checking your portfolio constantly. Do not make rash decisions based on market fluctuations or sensational news headlines. Stick to your long-term plan, and remember that market volatility is a normal part of investing. Patience and discipline are far more valuable than trying to time the market. Sixth, embrace consistency and the power of compound interest. Regularly contribute to your savings and investments. Even if it is a small amount, the magic of compound interest works best over long periods, allowing your investments to grow exponentially over time. Start early, invest consistently, and let time do the heavy lifting for you. Finally, do not be afraid to seek professional advice. A fee-only financial advisor can provide personalized guidance, help you create a robust financial plan, and keep you accountable to your goals. My journey has been a testament to the fact that while mistakes are inevitable, they can also be powerful teachers. I am now committed to sharing my experiences and the lessons I have learned, hoping to guide others toward a more secure and prosperous financial future. It is okay to stumble, but it is crucial to learn, adapt, and keep moving forward with greater wisdom. Thank you for listening to my story. I hope it serves as a valuable guide for your own financial journey.